Interest rates, two little words that can have a massive impact on your mortgage. They can make or break your home buying plans. But don't stress, we're here to make sense of all of it. This episode, we're going to be talking about fixed rates versus variable rates, share a simple breakdown of how much a rate change actually costs, as well as an interest rate forecast heading into 2025. As always, I'm joined by my dad, John, property developer and finance broker.
Thank you for having me again, Nicola.
Dad, let's jump straight into this. What are interest rates?
So why don't we start with where interest rates come from? There's this thing in Australia called the RBA, the Reserve Bank of Australia. They control what's called the cash rate, and they're the ones that actually supply the money to the bank. We then borrow money from the bank. The RBA are the ones that can control the cash rate, which is pretty closely tied to the interest rates the bank charge. So essentially all money comes at a cost. Even the banks pay for the money. And naturally, they want you to pay more than what they pay.
So that's what an interest rate is?
Yes, as a very oversimplified version. So that's where it comes from, and that's what it is.
So when I'm borrowing money from a bank, the bank's going to charge me interest on the money I borrow?
Correct.
So how do interest rates play a part in mortgages?
So in summary, the higher the interest rate, the more your repayments are going to be. So at the moment, we're at a position where, so in 2025, rates are at around 6% for an owner-occupied home loan. So if we go back 3 years, rates were almost mid-twos, 2.5%. So the rates were very low. Mm-hmm. So your repayments back then on a home loan were a lot lower than what they are now. So what that meant is what you could borrow back then to buy a house was a lot higher than what you can borrow now to buy a property. So interest rates have a big effect on how much you can borrow because your repayments increase the higher the interest rates are.
So why do interest rates increase then?
Yeah, so the interest rates are generally controlled by the Reserve Bank of Australia, so the RBA. So their role is to control inflation in Australia. So when we have...
with inflation, higher inflation means higher interest rates?
So generally what happens is when there's high inflation, the Reserve Bank will act to increase rates to reduce the amount of spending in the economy. Okay. So by increasing the rates, spending should reduce, which means inflation should drop. So inflation is basically what is a calculation of how much products are increasing every quarter, for example. So let's just say a carton of milk might be $3.50 today, but then in a year's time, that might be $4. So that inflation rate is a percentage of that increase.
Yeah.
So what the RBA's role is to try to control inflation between 2% and 3%, so prices don't escalate too high. So the way they do that is by controlling demand and demand for what products people buy. So the way they do that is reducing the amount of money they have available to them to be able to spend.
So right now, interest rates are high because inflation is so high and cost of living is high.
So cost of living has gone up because of inflation in the last 2 years. So what they've done, they've increased the interest rates to try to control inflation. So in the last 6 months, inflation has dropped and it has stabilised and is now getting to a level which the Reserve Bank is now comfortable with.
So how do interest rate changes actually affect my repayments? Would the interest rates have to go up like 3% for there to be an effect in my repayments, or only 0.5%?
Well, rates can change by 0.01% for there to be a change in repayments.
Oh, wow.
So it doesn't matter what the change is, your repayments will change. But let's just use an example of where rates are now and if rates were to drop by, say, 1%. So if you were to borrow, say, $500,000, your repayments will be around $3,000 per month based on the current rate of 6%. Okay. If rates were to drop 1%, repayments would drop to around $2,700 per month. So by a 1% drop in interest rates means you're going to save around $300 per month, which is quite significant. So think about that now. Every percent, repayments dropping by $300 per month.
Yeah.
We had rates at 3% not too long ago. So that's 3% difference. So that's nearly $1,000 a month difference on repayments compared to where we were 2 years ago.
Yeah.
On that $500,000 alone. That's a big difference. So rates can make a big difference in what you can afford. And can you see the reasons why the Reserve Bank controls inflation with interest rates?
Yeah, to balance.
If they increase interest rates, you've then got less money in your account to be able to spend on products, which controls the demand on those products, which reduces the inflation.
And then the cost of living will go down.
Correct. It will not go down, but it will stabilise. So the prices won't increase by as much. So they'll increase by 2 to 3% every year, as opposed to, say, 5% every year.
Yep.
So back to that equation we just worked out before on $500,000, if you were to borrow $1 million and rates were 6%,
Yeah.
if rates were to drop by 1%, your savings per month would then be $600 per month. So again, that reduction in rates does make a big difference on what your repayments are. And that's only 1%. So we're at 6% now. We were at 3% 2 years ago. So that 3% difference is $1,800 a month difference on repayments as compared to where they are now and where they were 2 years ago. So that's a huge amount extra out of someone's pocket, what their repayments were and what they are now.
That sounds bad.
It does sound bad because your repayments have increased, but the alternative is that products keep increasing in price, so the cost of living will be a lot higher. So whatever you're buying will be a lot more expensive.
But if your interest rates are higher, then your cost of living might stabilise.
Correct. So historically, interest rates have jumped as high as 20% in the past. And that's because inflation got out of control and the Reserve Bank had to react to reduce inflation.
Yeah.
So what we're seeing now with rates at say 6% is actually quite low compared to history. So the Reserve Bank has got a lot better at managing interest rates compared to where we were, say, 3-4 decades ago.
Okay. Why is that?
Probably economists learning about the cycles and the way things work in the economy.
So I've heard the terms fixed and variable rates. Which one's the better one to choose?
It really depends on where we are in the market cycle. So I know of clients that 2-3 years ago fixed their rates in at 2%, 2 to 3%. So they locked their rates in at 2 to 3%. So while interest rates were going up and now 6%, I was still paying 3%. So they locked just at the right time. So fixing can work in your advantage. So if it's at a lower rate,
fixing?
Well, it all depends. So at the moment, fixed rates are actually lower than the variable rate. So you can get a fixed rate for around 5.5% to 5.7% with most banks.
Yeah.
Whereas a variable rate is 6%. Although that is very attractive to go for a fixed rate, there is talk of rates dropping this year. So if you do fix your rate, you're then fixed for that period of time that you decide to fix with, which is normally 2 to 3 years.
Okay.
So if you fix your rate today, for example, at say 5.7% for 3 years,
you can't.
If rates were to drop to 5%, you're still at 5.7%. So you're then paying a higher rate for that 3-year period.
But then vice versa, if it was 2...
Whereas if you fix, let's say, if rates were 3% and you fixed at 3% 2-3 years ago and rates went up, you're fixing at a lower rate. So your repayments will remain low for that period of time.
So there's no real better one. It's just whatever's happening.
It's a hard market to play because no one really knows what's going to happen with interest rates. At the moment, well, what I normally say to people, if you're going to struggle in your mortgage repayment if rates were to increase, I would say fix your loan because you don't want to be in a position where rates were to increase and you can't afford your repayments. At the moment, the chance of rates increasing are probably very slim, but it's more likely that the rates will be dropping this year. No one knows when, but there is talk they will be dropping this year. So fixing at the moment probably isn't ideal, but it is something that you can consider.
But if you can't afford it, then you should consider it.
You should consider it. The other thing I also like to point out to people is that you can hedge your bet. So you might have a loan for, say, $500,000 and you might go half fixed and half variable. So you might fix half your loan and keep the other loan variable, allowing you have the best of both worlds. The other benefit of having a variable rate as well is that you can make extra repayments in your loan. Okay. On a fixed loan, not many banks allow you to make extra repayments.
So you have to just make, say, the monthly or fortnightly
Correct.
repayments.
So you can normally make around $10,000 extra per year with most banks, which depends on your situation. Sometimes you might want to pay more than that. But on a variable loan, you can make extra repayments. The other thing is with a variable loan, you can have offset accounts and redraw facilities, whereas fixed loans, you can't have that with most banks.
So are there any other downsides to fixed rates?
Yeah, so let's just say you fix all your loan today at, say, 5.7%. If rates dropped to, say, 4.5% and you're at 5.7%, you're obviously paying a higher interest rate than what you would have paid if you went variable.
Yeah.
But you do have the option to cancel your fixed rate and go back to variable. But the banks charge you break costs. So that break cost is pretty much a calculation of what the bank is losing by them dropping your interest rate. So you might decide to break your fixed rate.
So you end up essentially paying the same thing.
Yeah, close to that same amount, yes. But the other problem is if you wanted to sell a property that has a fixed rate and rates drop and you've got to pay a break cost there, you're actually paying break costs for no reason. So you really got to understand if you do fix, your plan is to keep that property for a while because by not keeping that property and having to break your fixed loan, you could be
And
charged
that's where you
fees.
just have to go to a finance broker and get advice from them.
Well, you get guidance from them to sort of understand what your options are and do your research.
Mm-hmm.
But it's also knowing what you want to do with that property as well.
So I remember a few episodes ago we talked about a buffer rate. What happens if the rate drops?
Yeah, good question. So at the moment, say rates are 6%, banks apply a buffer of 3% on servicing. So you've got to show the bank that you can service loan at 9%.
Okay, so that's significantly higher.
If rates were to drop to say 5%, they add the 3% to that. So then you've got to show the bank you can service at 8%. What that means is that as rates drop, your borrowing capacity will increase.
Okay. So my biggest takeaway from this episode would be that you always want to show to the bank that you'd be able to service more than the current interest rate.
Correct. Well, you have to be able to show to the bank that you can service at a high interest rate, yes.
And then also choosing between a fixed or variable rate, you would always have to reflect back on the market and see what's happening at the time.
Yep, definitely. So really understand what's happening with interest rates. Speak to your finance broker who will give you the options that are available to you.
Yep.
And help you make an informed decision as to which way you want to go, and also understand what your plan is as well for that property.
Thanks so much for this episode, Dad. Hope you guys have enjoyed this episode, and we'll see you next week.
Thank you, Nicola. Thank you.